Warren Buffett has accumulated a net worth of over $100 billion. He didn't invent a groundbreaking technology or inherit a vast estate. He generated this fortune entirely by winning in the stock market. But there is a strange contradiction at the center of his success. The specific trading method that generated his first few $1,000,000 is entirely different from the framework he used to build his billionaire empire. Born in 1930, just after the onset of the Great Depression, he spent his early childhood watching his neighbors struggle through a severe economic crisis. Growing up surrounded by extreme scarcity hardwired his brain for intense frugality. That constant awareness of losing everything formed the bedrock of his earliest approach to investing. Later, as a student at Columbia University, he met the economist Benjamin Graham. Graham taught him a strict, numbers-based art of analyzing balance sheets to find deep, hidden value. This chart shows what Buffett came to call the cigar bet strategy. He looked for terribly performing companies on the verge of bankruptcy. If you find a stock where the market price has plunged well below the actual cash value of its assets, you can scoop up the guaranteed margin in between. But this method has a strict mathematical limit. It does not scale. When a strong bull market takes off, stock prices naturally rise. Those deeply undervalued garbage stocks simply disappear, leaving a cash-heavy investor with absolutely nowhere to put large sums of capital. To move past making millions and start building a billion-dollar holding empire, Buffett had to walk away from the exact mechanical framework that had guaranteed his initial survival. The turning point came through the influence of his business partner, Charlie Munger. Munger convinced him to stop looking for fair companies at great prices and start looking for great companies at fair prices. Ironically, the ultimate proof of this pivot was Berkshire Hathaway itself. Originally a failing textile mill that Buffett bought as a cheap cigar butt, he shut down the declining looms and repurposed the corporate shell into his primary holding firm. This animated model shows his new critical metric for success, the economic moat. He needed businesses with a structural, untouchable competitive advantage that naturally repels market competitors. Consider Coca-Cola. It holds a century-long brand dominance and massive global market share. That deep cultural integration makes it nearly impossible for new beverage brands to disrupt its position. By seeking out these deeply protected moats, Buffett stopped acting as a short-term stock scavenger and became a long-term owner of highly durable businesses. Identifying a world-class business remains a hollow victory without the sheer volume of liquid capital required to actually take ownership of it. To solve this, he stepped into the insurance industry, buying companies like National Indemnity and Geico in order to capture what is known as float, the enormous piles of cash generated by everyday people paying their monthly premiums. This diagram illustrates the structural advantage of float. An insurance company collects cash up front and holds onto it indefinitely, before actual claims need to be paid. Buffett realized he could use this refilling pool of capital to fund his major acquisitions. He built a self-sustaining wealth machine. He took other people's temporary money, gathered in the float, and used it to buy permanent, high-quality assets. Possessing infinite float and identifying perfect moats guarantees nothing if the operator hits the panic button at the first sign of market distress. The trap that attaches conventional Wall Street traders is emotion. They allow sudden greed, anxiety, and short-term thinking to dictate when they buy and sell. To counter this, Buffett operates by a strict contrarian rule. Be fearful when others are greedy, and greedy when others are fearful. This stoic emotional discipline allows him to ignore daily ticker fluctuations and focus purely on long-term economic durability. Billion-dollar fortunes are secured by moving past daily market predictions to focus on capital, quality, and the relentless emotional discipline to stand firm when everyone else is panicking.